You have an election to make at retirement, and you have three choices. Are you going to leave your spouse 50% of your annuity? In so doing, you will take a 10% reduction while you're living. The cost will be 10%. Or you leave them 25% at a 5% cost, or leave them nothing. You have to choose one of these three options for your FERS retirement system. You will elect the 10%, the 5%, or the no reduction in your pension for the rest of your life in exchange for a benefit when you die for your spouse. What do we call that, class? You die, somebody else gets a benefit. That's life insurance. You did it, that's right. So you now have your biggest life insurance decision you've ever made still in front of you. That was not what you thought coming in today, was it? We're talking 10% of your annuity the rest of your days. So let's walk through an example of retiring. You have a $22,000 annuity. 10% of that is $2,200 a year, right? That means you're drawing $20,000 a year. If you pass away, your spouse gets $11,000, which is 50% of the larger $22,000 number. Okay? There it is. There's your cost of insurance and the benefit that they get. Now, let's just assume by accident both of you live 25 years from that date. With COLAs being built into your pensions, now your gross pension would have been $36,000, but 10% of that is $3,600 a year, leaving you with $32,000 in annuity. If you die, your spouse gets $18,000, and so you have paid $72,000 over that 25-year period. Just in case you would have died, your spouse would have picked up a monthly check. Your spouse dies after 25 years, what happens to the $72,000? It's gone. It's a sunk cost. Okay? It is out of there. You do get the step up from your $32,000 pension to your $36,000 pension. You get to pick that back up, but no more, nothing else with that $72,000 or that cost built in. So that's a consideration. Now, you've got two things going on. You've got a unique situation that most people don't have, in that you have this large pension check on your head, on your life, and it probably, for most people in the room, it probably does need to be insured, either via survivor benefit or life insurance or outside assets. There probably needs to be some insurance, because your big check is probably, on average, we see hundreds of these cases every year. I bet your pension check will represent about half of the retirement income in the household when you retire. And for half of that to vanish would be pretty significant loss for your spouse. So you have to weigh that out. I want to compare for the next few moments two options: life insurance and survivor's benefit. Let's put them side by side and see the pros and cons on both sides. This is not an exclusive or all-inclusive list, but it's a good start. Okay? First, you have payment options. When you pass away, life insurance can be paid out in a lump sum or in an annuity check. Whereas if you pass away, leaving the survivor's benefit to your spouse, they get the monthly check the rest of their life. If you have a life insurance policy, you have flexibility and control of that policy while you're living, and when you pass away, that money can be controlled and managed however is appropriate for the surviving spouse. Whereas survivor benefit is you elect it, you pay it the rest of your life, you pass away, your spouse gets it the rest of their life, game over. There are no other tricks or issues. The cost, we talked about that a little bit already. It depends on your health. You buy life insurance in the open market with your health more than your money, right? You have to qualify for that insurance. But it is based on age and health versus the standardized approach to the survivor's benefit options. So shopping that, trying that out, seeing if something else fits better from a price perspective is typically a good thing to do. You have probably not thought about this before this class, but you are a wise consumer on many different things in life, right? When you buy a car, when you buy groceries, whatever it is that you're buying, this is something you're going to buy. You need to see it in that light and be a wise consumer of your survivor benefit elections. Next, we have taxes. To reference your question just a moment ago, your statement a moment ago, you get a tax-free death benefit from a life insurance policy. There are no taxes due because it was paid with after-tax dollars. If you go to publication 721, I believe is the number, in that pub, it walks through the calculation that shows that about half of the survivor's benefit pension is typically taxable. So they don't escape taxes. It's cut in half typically. All right. Health insurance. This is probably the most important one on the screen. Do you intend to leave your spouse with the option of carrying on the federal health insurance if you pass away first? Are they dependent on that health insurance now, and will they be later in life? For most of you in the room, the answer is probably yes. And if that is the case, then they must be on the annuitant rolls the rest of their life. You must leave them some survivor's benefit so that they can continue to qualify for the federal health insurance program. So for a lot of people in the room, I just knocked out the zero option. You can't leave them nothing. You cannot leave them a zero. You must leave them either the 25 or the 50% option. So you're negotiating those 2 points instead of the other because you may want them to have access to the federal health insurance. Changing beneficiaries. Obviously on a life insurance policy, you have flexibility and control to make the beneficiary change. So if you did pay in for 25 years, whatever it was, $60,000 into a life insurance policy, your spouse dies, you just make your beneficiary your children. You have that beneficiary change option that always provides value to your heirs, whereas you don't have that when you choose survivor benefit. Inflation protection. You saw a moment ago in the presentation that if you elect survivor's benefit, you do get whatever COLAs Congress allows retirees to get. As long as Congress is allowing retirees to get COLAs, your surviving spouse gets that benefit. If that ever stops, you don't get that anymore. In the life insurance world, it depends on the kind of insurance and the kind of investments that are going on, all those other factors. So it can have some inflationary protection, but you need to make sure you understand that the program is built in such a way to provide that. So I want to make this point a second time because it is very significant. There's a connection with survivor benefit and FEHB for those people that are not dual feds. And I put that on here one more time just to make sure you understand. And you can insure, or you can make someone else your beneficiary. It doesn't have to be your spouse. You can make your child the beneficiary. And so they'll draw a check the rest of their life. But the cost is not the 10% anymore. The cost can go up to 40% of your annuity. How much do you love your children? That's the question, isn't it? I love them, but not that much, right? So if you have a need, if you have someone dependent on you, special needs or what have you, that's younger potentially, again, you may consider a life insurance policy to cover that. You may come out much more cost effective than using the program in that capacity. But it is possible you can do that.